Good morning, ladies. Probably have a few other people strolling in on this rainy Saturday morning. It is Saturday morning after all, so I really appreciate you guys, you know, really like your enthusiasm. And so we shall, this is a free new member introductory coaching session. I do two of these complimentary ones right off the bat. And then if you choose, you can always sign up for the ACS advanced coaching sessions at your own time. They're extremely helpful in navigating markets, more importantly, in making money and controlling your trades. This free market update, this free introductory coaching webinar will be uploaded to the Clueless Daytrading YouTube channel that you all know about by now. And please spread the word. Anyone and all the free videos that I publish up there are available for anyone to review. Lots of great information, lots of real understanding of why things happen in the markets. So do spread the word so others can review them and hopefully join us at Clueless Daytrading as paid members. On that note, it is Saturday, May 19th, 2018. Approximately 10:17 a.m. and let us begin. So what we're going to do today within the next 60 minutes or so is we're going to basically walk through charts because that's really the essence of what my service does. We're a technical service. We try to navigate the markets and profit from it through visual charts. As I've always said, charts are nothing but a manifestation of human behavior. In this particular case, human and machine behavior, because the machines, what we call algorithmic high-frequency trading black box computers, that's not a Star Trek term. That is the reality of what happens in the markets these days, what I call the new normal. I've been saying this for a whole bunch of years, and now people are finally starting to accept it because this is the new normal. The machines move the markets around very quickly in nanoseconds. We see that happen every single day. But what we try to do here at Clueless Daytrading very effectively most of the times is we try to chart and sketch out the roadmap so we're prepared for what might come our way despite the rapid movements that happen in the market, what we call volatility. It's really as simple as that. Volatility is not meant to make you comfortable. Volatility is created by these machines, by large investment banks and hedge funds that run these algorithmic high-frequency trading programs, activity both on the buy side and the sell side to create revenues. Really, that's what it is. The more they get in people panicking, buying and selling, people getting excited and buying and stuff like that, more trading activity, more trading revenues for those particular brokerages and banks. And on top of that, they are constantly day trading the markets, and that's just the way we one aspect of our service is we day trade the markets too, and markets and individual stocks. Hedge funds also tend to day trade. It's really as simple as that. And that's why things get a little bit tricky because they move a lot faster and in larger amounts and move individual stock prices around in a very random fashion. And as most retail traders who don't quite understand this concept, they think, hey, there must be a reason behind why this thing is moving or not moving. Well, in a lot of cases, there is no reason. They are just simply day trading. They got 2 points on it. Let's say 10,000 shares. That's 20,000 for that particular hedge fund in a matter of minutes. And so, case in point, any of these tech stocks, for example, which have high beta momentum stocks, they'll move around 2-3 points on a blink of an eye. So as long as you're informed about it, then you can somehow manage, and I think very effectively manage, even if you're actively trading. But if you're looking to hold those things on a swing basis, my charts are of extreme importance. So that's what we're going to do today. Okay, fair enough. Mm-hmm. And so on that note, let's start off with the bigger picture, and then we're going to zoom in towards the smaller, towards the intraday stuff that happens that looks like a EKG cardiogram. When you look at the 15-minute charts. So we'll start off with the bigger one, the zoomed out version. Then we'll move into the zoomed in version, and then we're going to look at a couple of swing trades, which I'll highlight. Not that particular necessarily that particular stock, but why sitting patiently on a particular stock, which is on a large technical breakout, can pay the bills very, very handsomely. Patience is required as long as there is no technical deterioration or breakdown. So that's what it is. Now, saying all that, I do appreciate your support here at Clueless Trading, and I'm always here as much as possible, as you know, engage with my members and try to answer their questions as quickly as possible. But most of the learning that's going to happen through gains and losses, and keep this in mind, is going to come from you. In the sense that trading, even in very small amounts, the markets will be the ultimate teacher. My charts, my tactical charts, are simply going to be the effective tools. But you will be the ultimate student, and the market will be the ultimate teacher. And I've always said that, and it always applies to me too. So here we're looking at what we're looking at right here is let me just draw this line here. Very important. I don't know why I didn't have that before. There you go. The big daddy of lines where the big breakdown started. Okay, so this is the S&P 500 futures. Now, some new members sometimes they ask me, well, why do you chart futures? Well, we chart futures because the futures are really the determinant, which are traded by commercial traders and non-commercial traders. That's what they call them, hedge funds primarily. And the commercial and non-commercial traders at the Chicago Board of Options Exchange are moving moving the futures, trading the futures in a very rapid fashion, and the futures determine whether you're going to, what the overall direction of the market will be overall. Okay, so when the futures start moving, if we can understand the movement of the futures, at least chart them effectively, then we know what's going to happen on the front end. So I call them like the kabuki theater, where or any theater for that matter, where the actors are going in to change behind the scenes for the next scene, and that's what E-mini futures are. E-mini futures are extremely important to understand. I am not a futures trader. I've traded futures before. I might be trading it again. And futures, as you know, trade 24/7 globally, what we call the Globex markets. So very, very important to understand what the structure is, so you can understand what might happen on the front end. And of course, this is directly correlated with the SPX and the SPYs that we trade. So saying all that, here's your larger picture, and I'm going to walk through this very quickly. So back in February, we had in January, we had the massive run-up where a lot of excitement. This is 2018, beginning of 2018. There you go. I'm going to change this pen color to blue. There you go. So we had that massive run up in January, and then all of a sudden we had a literally this was a mini financial collapse or market collapse. We dropped within a matter of days. Remember, this is a daily chart. 1, 2, 3, 4, 5. Within 5 days, we dropped thousands of points. I believe the Dow Jones dropped about 1,200 plus points, and this was not something pleasant. We managed to catch bits and pieces of this move. We did very effective moves on the reversals, and of course, seeing the broader picture, you're not seeing the 1 hour or 4 hour or 15-minute type of hammer reversals, even though you are seeing them here. These are large tails, very large tails, and that's what the shorts are covering. And we managed to catch a whole bunch of these moves. No one in this business can catch, even though the charts will show you that no one can catch from exactly the bottom, because they happen so quickly. You can, but I'm just saying in general you can't, and then sell exactly at the top. But as long as you're catching, and this is true of stocks too, the meat in the middle, then you are doing fine. Then you're doing fine. I've regretted so many times where I've detected the bottom to the spot, even recently. Yet I tend to sell along the way up and not hold all the way up through. That's just what we call effective trade management, and the term for it I use is ETM. All right, so extremely important to understand that. But all right, so moving on from that, we we saw this, and now we are here. So as you can see here, there's different ways to look at this particular. Let me actually, instead of the forecast, let me walk you through it. So each of these lines that you're looking at are extreme are the supply zones, what we call where the big selling came in, where the big boys got caught or the big panic sells occurred. Remember, mutual funds are the largest 800-pound gorilla in the market, trillions of dollars. So when mom and pop calls in and say, "Look, I'm getting nervous. Please sell me out of that growth fund and put me in money market till things stabilize." That's a normal thing that happens with normal human beings. They panic at the wrong times and they get excited at the wrong times. That's just the nature of human emotions. And we tend to fight that as much as possible here at Clueless Trading. The mutual funds have to, at that point, sell a bunch of their portfolios and move it back into the money market accounts because mutual funds are not if a client calls in and says, sell, you got to sell. So end of the day, you get this big pressure because mutual funds are marked to market after the market closes or right at 4 p.m. So you tend to see a lot of activity at the end of the day. To make a long story short, there was a lot of panic selling, as you can clearly see. This was the euphoric buying right at the beginning of the year, and what we call wave 5. You can look at my video from that time. I did say that this was not good, even though it was exciting. You woke up every day, and then you started to, you just kept on going higher. But as a trader, keep in mind that a market's going up every single day is not a good thing. The reason being that if you're not in a position, you're chasing a position higher and higher to get in. The bargains are not coming to you, and then the ball drops. It's always like that. It's always like that. So I prefer markets which have a certain structure, which open flat to down, and then they move up during the day, and then end of the day there might be a little selling, but as long as the structure remains on an uptrend. So that is a perfect market. A perfect market is not necessarily the one where every day it keeps on moving higher, because I tend to take profits as it goes along the way. And then if I have to rebuy that back again, I'm like, come on, am I going to buy that up $15 again? So tend not to do that. All right. So this is what happens. And of course, when the bargains really appear at these levels, there are very few people to be seen, especially retail emotional traders, as I call them, RETs. That's my term. Those are the best times, what we call I consider them to be the perfect moments to get in cheap. Yeah, they vacillate around, but then you're sitting there, and in 2 days' time, bang, make the big money. It's just the way it is. So this is where we are right now. So each of these lines are the supply zones or the sell points, and each of these lines down here, the red lines, are basically the buy zones where the supports got activated and the big money came in, and or the machine-driven money, automated money came in and started buying the market. So these are demand zones, call them D, and these are sell zones, supply zones, call them S. So demand zones can also be called Bs, where the buy zones are. And so that's how the lines are drawn. And to each of these levels, you're going to be met with selling. You're going to be met with selling. So as the market starts to recover, and it's in a recovery phase right now, you are going to hit close or at those levels, and you are going to see sell programs come in, because money that got trapped at those levels, they are now at that point even, and that's called resistance. People I used to ask my clients back on the days in Wall Street, do you know what resistance means? They're like, no, well, that's where the stock, hits a wall. Well, why does it hit a wall? Because from a behavioral standpoint, if you held on to what was sold off on the 22nd of March, you're now break even at 15th of May. And at that point, you're like, wow, I'm break even. I got my money back. Thank God. So especially retail traders or mutual fund traders, mom and pop, they'll be like, okay, I got to put the money, I got to put it in money market. Let's see what happens. Okay. So that becomes resistance at that point. Supports are the levels basically where, a short, for example, shorts come in, and let's say they're shorted here on this large candle. And this applies to stocks too. And they're saying, okay, looking like that's the level that made some real decent money. Shorts make money, as you know, on the downside. And So they're profitable at this point. Let's say they shorted something here at 10. Now it's at 3. They basically made themselves 7 points. Okay, they made themselves 70% on their money. So they come in, they start to buy at that level. Shorts cover, new money detects that that's a support level. It starts to push in, and each of these red lines are major support levels in the market. So that's really as simple as possible that you can read these charts. And then there are structures. I don't want to make it too complicated. Try to keep it very simple. This magenta line here is your 2018 break-even level. We fought very hard here to get up above it, and it broke above it with fury. These candles, which are the very powerful bullish engulfing candles, this is known as a breadth thrust, okay, where big money came in hard. And they are expecting that money to remain, they're sitting tight, because a lot of the big money is not trading on a 10-minute basis. The mutual funds who bought in really hard at these levels, that's why these candle formations are billions and billions and trillion plus dollars when you add them up. They are just the way this was multi-trillion dollar type of sell-off. These are multi-trillion dollar type of buy-ins, and so they're sitting there, and so far, as you can see here, this is a flag. This is a flag. We discussed this on the first introductory video. One of the types of flags. The flag is still intact. So taking any hasty action, saying, "Oh my God, we're going to crash and burn," well, the technical picture is not telling us that. If anything changes, I'll be the first one to let you guys know, because I'm monitoring this thoroughly on your behalf and for my trading 24/7, literally 24/7, and of course during trading hours. So at this point in time, and then I have the channels here. This is the wide channel. Okay, all I did was join the major inflection points right there, right there. And the reason why these charts can be drawn to such perfection is simply because they are driven, the market is driven primarily by machines, black boxes, high frequency trading computers. So that's the reason they can mathematically be put in a geometric shape where we can see where the money making opportunities are. Good so far? You guys getting it? Yes? Okay. Now, so then there's a wide channel here. The lower end of the channel again is 2650, and the upper end of the channel you can see here is somewhere around 2790 or so, heading towards 2800 right there. So that's your wide swath, and that wide swath can cause major turbulence in the markets because there are hundreds of points on the Dow Jones Industrial Average. Now, quick rule of the thumb: one S&P point or one E-mini translates into roughly 6 or 7 Dow Jones points. So a 10 S&P point move, that means the Dow Jones Industrial Average moves 60 to 70 points. Okay, up and down. So keep that in mind. So these things are embedded in me as second nature, and it's very easy. So train yourself to look like that. I mean, to calculate like that. So if we are at 20, we are right here closing around 2713. So do the math. If we drop from 2713 to break even level back to 2680, so we are at that point 33 points from here, right? 33 points. So that'll be minus 33 points on the E-minis. These are very, very relevant on a daily basis for your trading. So 33 points. So that's a mini flash crash. 33 points times 7. Okay, using the factor of 7, you're looking at roughly, and always take the higher number. You're looking at a drop of 231 points. So you lose 33 points from here to here just to test the 2018 break-even level, which is major support. Then you are losing 231 points on the Dow. That means the Dow, which closed at 24,715 on Friday, will drop 231 points So quick, 1 second. 24,715 minus 231. You're looking at the Dow falling to 24,484. Now, for some the average trader who is not this well versed on understanding these technical dynamics will be like, oh my God, this is just the scariest thing. We're down 231 points. They are just going to be panicking, sell a whole bunch of stuff, do all kinds of stuff. All right. And all the market's going to do is test this 2018 level. And in my estimation, we'll have a pretty powerful bounce back, trying to get back into this zone here, the trading range here. And that'll be another quick reflex bounce, which can last anywhere from hours to a day or so, because that's the speed of how these machines move. There'll be another reverse equal and opposite reaction of 230-point move up here. So at this point, the channel is still intact. The wide channel is still intact. The flag is still intact. The levels, you can clearly, you can clearly see where they are. Now, it's extremely important before I go any further that all of you, and I've said this to all my members, in order to be very effective in understanding and managing your trades, because you're dealing with real money here, you need to replicate these charts. You don't need to be exact on that. On the advanced coaching sessions, if and when you guys sign up, I'll help you set these charts up on your screens directly from here. And the bottom line is that you need to use investing.com, which I've found extremely effective. It is a subsidiary of TradingView, and these are real time, and you don't have to pay anything. It's free. All I did was register my my email. Only thing I pay is for the ad-free version. I think it's like $30 for the year or something like that. And so you need to replicate these charts, and you can literally control all your trades sitting in this cockpit of investing.com. Thinkorswim is extremely powerful, and then I use another very advanced platform known as Quad. I'll get into that at one point on the ACS sessions when you guys join. So bottom line is that you need to replicate this. This is the first and the most critical thing you need to do. You need to go to investing.com, put your email, register on it. Even the what I call the naked charts without any lines drawn on it, any structures, you can see the movements of the candles. And each movement of these candles, remember, this is a daily. So each of these candles is a day. And then we're going to zoom into the 15-minute ones. And you can see this movement of those candles will give you an idea what's going on. So I'm constantly aware of it. It doesn't mean I'm constantly trading every 5 minutes, but I'm fully aware of what's going on. So very, very important. So this is where we are right now. And this is how you read this chart. Any quick questions before we move on?
No.
On top of that, the clouded area is the Bollinger Band. The middle line, this is the mid Bollinger. And I try to keep this simple by keeping just a few structures on it, so it's easy to read. The faster you read a chart, the faster you can gauge the movements that are about to happen. Just like anything else, any other profession, the more you do it, the more you start to develop your sixth sense, or your what we call gut feeling. So good. Let's move on. Oops. All right. The next one, this is the futures. The next one is your actual S&P 500. Now notice there's a slight difference here. This is the daily starting 2018. This is what it looks like, right? And this is the same chart, S&P 500. See what I'm talking about? So the futures have more fluidity. They tend to be more liquid because they are the first level of movement on the back end. So I look at both constantly. The SPX is more structured. There you go. Interesting, huh? So and so I'm going to I'm going to show you this again. Just there you go. Same chart. There's your SPX. Same chart, but look how different it looks different because more structured. Now, the S&P 500 is looking like this. Same story here. This is more Annotated, more detailed. Each of these arrows are where, and anytime you see these massive sort of Chinese firecracker type of bottle, fire sort of bottle rockets or whatever they call them, and this is actually not a Chinese firecracker. These are those bottle rockets, that you get them in Pennsylvania and stuff when you're crossing the border because they're banned in Jersey. You put them in a bottle and you light them and boom, they go, right? So these ones are. This is a more detailed chart. It has the highlighted versions of this one does too. Oh, this one is just levels. This one is showing you all the gaps. Very, very important. Very important. Each of these gaps are where the market gapped down or gapped up. Here the market gapped up, fill the gap. There's that gap. And look how precise this chart is. And I live and breathe by these charts, okay? So it went exactly there, like I said, touched the lower end of the gap at that 27.42. You guys remember from last week, and then it pulled back. There's another gap here. It touched this bottom. There's a huge downtrend line here, this red line. It kissed it. It moved higher. So the market right now is in a very tight trading range, and nothing new about this. And that trading range is exemplified by right there. The wide trading range is 2,700. That's why the red line is here, right there, the lower end of the gap. That's why the red line, I put that on purpose. That's about 2,700 or 2,696. The lower end of the upper gap is 2,742. Let's look at the upper end of the gap, 2,750. In my opinion, it will get filled. My experience in the markets, since I've been actively trading as an independent trader since 2011, and prior to that, I was trading on my own, but I wasn't a trader when I was on Wall Street. So bottom line is that I've seen this happen always. Gaps always get filled. There's an old saying nature hates gaps, and gaps get filled. And there's a reason behind it. Well, on the ACS sessions, I explained the behavioral reason why that happens. So anyway, let's look at the upper end of the gap at 2,750. Let's look at the lower end of the gap at around 2,700. Let's be specific. 2,696. So 4 and 50. That's 54 points. By now, you know how to calculate the thing. So I'm going to ask you guys. 54 S&P points. Okay, SPX points is how many points on the Dow Jones? Roughly. Remember, it's a factor of 7.
378.
There you go. Okay, so thank you. So on the Dow Jones, that is 378 points. Let's call it 400 points for even approximately 4. Kathy, you with us? Kathy? Okay. I hope you can, you're following this, or else, of course, you listen to the recording. So this structured level here is 400 points. Retail traders who have no idea what technical charts are all about, no problem, Kathy, with the microphone. You can always type in a question or two, and as long as you can hear it and see it, that's what's most important. But do get a headset and try to get that fixed, because it's more interactive on further ACS sessions or the free ACSs that I do, webinars that I do. Okay, 400 points. Now, they'll be going absolutely wild. CNBC goes crazy. They have absolutely no idea. The reporters are reading off a script. Oh my God, 400 points. It's still within that wide band. So you as a trader have to always, on the trade management side, always have to have cash on the side, because once it gets to the bottom end of the scale, it will bounce. Whether the bounce fails or not is not our concern. We'd like the bounce to carry forward, but at least we know where the major levels are where we can make some real decent money on a 24-hour basis. So this is your band, 400 points. So what the market's really doing right now, so this is 400 points, is it created a monster since the 22nd of March. One thing I'll add, and I used to say this when I started to see the massive movements on these as the machine started taking over the market years ago. I always used to say, that what happens in years and weeks now happens in days and hours. Seriously. Okay?
True.
And the speed and rapidity of the markets, the average human trader is still not getting it. They're like, oh my God, 400 points. Honestly speaking, who cares? Yes, it doesn't feel good when you're an SPX call and it goes from 6 to 2. But when you look at the overall picture and take advantage of it and feel great in the next 24 hours, which we've done repeatedly, both on the long side and the short side, primarily on the long side, based on what I see here at this point, then it doesn't come as a massive surprise. So it takes the average human mind, which is not trained to look at machine-driven markets, to really comprehend this. But it is the reality. This is the new normal, and even the media is finally catching on to it. You know. So look at this picture here. You have a very large W, a quadruple, quintuple, multi bottom sitting here at that 2580 level, 2600 level. That's why these red lines are drawn. Big support levels here. And we moved up, and we are now moving sideways. This sideways consolidation, as you know from my Twitter feed charts, and especially the last ones that I posted at the end of the day, end of the week charts as I called it, we're in a consolidation band of 400 points. It's going to be jiggered around, moving back and forth. The tweet coming out of Trump, a China trade negotiations, which are in the forefront right now, North Korea stuff, all kinds of things. All right, a big Dow Jones company like Walmart and stuff, going up and down, Boeing going up and down, things like that. They'll all move the S&P 500. So this is where we are right now. So when you look at this pattern, at least this is looking like this is what it's looking like. Generally speaking, that's it. This is this leg of the move. This leg of the move, as drawn on this green ascending triangle, a green rising wedge, is a bull flag. Multiple day rally. 1, 2, 3, 4, 5, 6, 7, 8th day, the market rested. 9th day came down, retested the gap. Nothing that big. It didn't completely fall into the gap and below this very large trend line. Go below this 18 level, well, then in that case, you can rest assured you can do a 2-day swing trade because these things happen fast, and trade the market all the way down to 2600. And the charts are clearly walking you through it. If these things happen, if this level breaks, you can basically go in there, buy a couple of SPY puts, leave it in there, because the chances are either it's going to bounce very hard from this level, or it's going to come down another 100 points. Remember, these are 20-point increments. I didn't create that. I'm just showing you what the markets do. 20-point increments on the S&P 500. That's roughly about 100 to 120 points on the Dow. But it looks like if it does this, if it did this, then it would be a perfect symmetrical triangle. Look at that. Remember, this wide moat here in light pink is a major support level and a gap right there. And from this, it'll bounce hard again, trying to attack the downtrend line. Whether it breaks or not, we don't know. But we're not at those levels yet. So this is where we are. So the way you as a SPX SPY trader, and I show the SPY charts too, but the SPX and the SPY are correlated directly because they're both ETFs. So is that this is sorry, the SPY is the ETF for the SPX. So this SPX being the root index, is you're looking at the gap, another gap here, which got, in pure technical analysis, they say, hey, once a gap is filled, you can't really use that as a gap anymore. I don't care. I'm always, like I said, I blend technical analysis to my style, what has worked for me repeatedly, and I use that. So that's fine with me. So this level is very important, the 2700 level. If we break that, the break-even level coming in. So everything is set in place. Big arrows, down arrows, where if it breaks the level, you're going to see some rapid selling, things like that. And that's pretty much it. Now, internally, just use I use very simple internals to show to my members. I follow about 30 to 32 other indicators, but that's on my personal side. If I showed all of them to members all through the day, they would just, their brains would be frazzled. That's not my goal. My goal is to try to keep it simple, technical, but very accurate. And so the stochastics right here, this being the daily, are still above 80 and kind of moving sideways. You can just visually see it. You need to calculate the numbers. They're not like going like this. Now, we'll see the possibility. Does it fall into this zone here, in which case they'll be selling down towards these levels, or does it kind of oscillate like this and then stay above? As long as it can stay above 80, that's showing strong relative strength, because stochastics are the second derivative of relative strength index, showing you the relative strength in the market. The relative strength in the market is still pretty good. Look at Boeing. That's a swing stock for us for a long time. We swing it back and forth. Boeing was up, what, $7? Look at John Deere. We called it on earnings, and it's still a swing trade. One of the biggest powerful moves that I've seen on a major component of the Dow Jones Industrial Average in a long time. So those are keeping up the relative strength in the market pretty well. So not much to say about this. Remember, candle dynamics is something that I cover very extensively on the movement of the candles and how to read them. Easiest way to read them is if you have a long tail, that means the shorts have covered quite a bit and you're going to be going up. And I love seeing, this is a doji in decision. This is still a doji. It's doji means just like, but the body of the candle is somewhere in the middle. And you can see how tight the range is. It's not like a long candle like this. So there we go. What is the blue arrow and the red arrow right next to each other? Okay, a very simple question and a very simple answer. If the market, this is a major sell level, like I said, 2750. That's why they have the red arrow. Why is there a blue arrow? If it breaks out above that, it's going to be a rapid move like this. And that's going to be the pattern completion number 2. There you go. So the reason I put the next to each other, because at those levels, the market can break out. Okay? And the market, if it break out, then that sell gets negated. Once it gets closer to this level, I will always be selling, because I want to see the reaction and then move in. Now, if it breaks out above that, then that is going to be that blue arrow that takes precedence, and it's going to move, because there is no guarantee what's going to happen here. I know there's going to be a bunch of selling here, because people and the machines that got trapped here, okay, money that got trapped here is going to sell. And that sell that's 378 points higher, right? Just like Mary, calculated. So 33 S&P points from here. We hit that. Now let me show you a trick about technical analysis, pattern analysis, pattern recognition. Another major topic that makes a lot of money for tactical traders, pattern recognition, and I cover very extensively on the ACS sessions, is if you look at this very quickly, then it tells you that regardless of volatility, which is standard procedure, this is a very large W that eventually resolves itself at the 2800 level. And that is major pattern completion. Pattern number 2. This is pattern completion number, well, you can call this 2, you can call this 1, 1, 2, 3, and the fourth one being the highs. The gap, right when they're close to the highs, 2800 plus, that means the market getting towards the all-time highs. I'm not even going there. What I'm seeing here, that on this level, this pattern looks valid. Can I call it as a high probability move? Nope. Why? Because the volatility is insane. There are way too many headwinds out there with the China stuff, primarily North Korea and things like that. Policy initiatives coming out of Washington D.C. that I can't do that. So I am going to follow my charts. But that's what it looks like. But first and foremost, this level here has to get completed. Now, will it be a smooth ride that it gets completed like immediately? I'd like to get that done by this week, so we know where we are. We hit that level on the way, or it can come down, retest this 2,700 level again, which is a major support, and then do this. And if it falls below this, the picture changes short term. That's where we are. Now, let's move on.
Frank, can I ask you a question?
Of course.
For the stochastics indicator, what's the difference between the oscillator and the RSI? That's all the options I have on my platform.
What's the difference between the oscillator, the McClellan Oscillator?
Yeah. If I plug in a stochastics on my charts, is the RSI better or the stochastic oscillator?
I don't use stochastic oscillator. I use just straight out stochastic.
Okay.
Yeah, I know there's at least 200 different indicators out there, and I've tested a whole bunch of them. I used the Darvas box quite a bit. I used to use the ADI directional index. I just find the the stochastics the easiest to manage in volatile markets, like the easiest to read. You know what I'm saying? Yeah. Because one thing about technical analysis, I always warn people, the deeper you get into it, the more trades you're going to miss. Because you're going to be trying to figure out, like, okay, what's that trying to say? In the meantime, the trade's gone. So I like to keep it simple. Like Clueless 8 style. That's the way it is. So the stochastics alone works out great. The McClellan Oscillator is also a very powerful indicator, primarily during extreme circumstances. What are extreme circumstances? 300-400 type point moves, 200 to 400 point time point moves. I quickly look at the McClellan Oscillator that's on my charts, and then especially on the Thinkorswim, and okay, it's down minus 200 on the hourly. The market is going to have a reversal bounce, reflex bounce. So that's one that I use quite effectively, and I'll show it to you guys. Okay, this is your weekly chart. Very interesting. I've been watching this very carefully. I constructed this last week. Here's your weekly chart. If somebody just looked at it, would they panic? The answer is no. This is your weekly chart. Every candle is a week. And I explained it in clearest terms. 2744, we break out of this, we're going to have this blue arrow. Just go like that. But this is a sell zone. That's where that big drop happened back, look at the bottom, back on the middle of March 19th. So obviously I can do this. The red and blue arrow again, Kathy. All right. So 2744 on the weekly, or 2742 on the weekly, which happens to be, look how good these things, look how perfect these lines are, is the lower end of the gap. See that? Lower end of the gap on the daily is a major resistance level on the weekly, right there. If we break out of it, bust a move, then on a weekly basis for swing traders, there's a good shot that we complete. Let me zoom in because this goes all the way down to February of 2016. Let's zoom in. There you go. Then there's a very good shot. Doesn't matter what happens on a 15-minute, 1 hour, and all the crazy stuff. But if we break out of this and stay within this range, then there's a very good shot that we hit the 2800 level again. Now, one thing I'll plug in. The stuff that I'm explaining to you in very simple terms and very effective terms is stuff that the good old JP Morgans, the Goldman Sachs, and believe me, I've been around the street, so I know. JP Morgan and these technical analysts are explaining to their top people. Trust me. All right? And I'm explaining in very direct, very accurate terms. So there's a huge level of value-added service at Clueless 8 Trading. No question about it. And so whether or not it's going to do that, we don't know yet. Now let's look at the internal stochastics. Good old STOs. The STOs are still trending higher, despite all the nervousness that's in the market. On the weekly, the STOs are still trending higher. Now, do they make a dive like this? Certainly can. For that, we can easily look back at our, and we have already explained that if it makes a dive down here and retest these downtrend lines and the 2018 break-even levels at 2680, then this is going to not crash and burn, because for it to crash and burn all the way down here, which would be a screaming buying opportunity, I necessarily don't want that to happen right away, right? None of us do. Then all it's going to do is retest the uptrend line going back to, as I explained, going back to that major inflection point of February 8th, 2016. Okay, so that would be this is a major uptrend line. What did I say downtrend line for? Uptrend line, and that uptrend line retest would bring the Stows and do a full reset. A reset simply means getting back into oversold zone at 20. In the meantime, this is the range. Now, this is not a range chart. This is a chart showing you, yeah, it's showing you the levels. It's also showing you something from a candle standpoint. Big bullish engulfing breakout after a massive hammer reversal. That's a hammer reversal, right? Straight up, long tail, the body of the, that's where it closed. Hammer reversal. Then a bullish candle. So a bull, a technical bull would say, this is really good. Yeah, we vacillated during the week. But look at the structure. Big green candle, this one, and then a doji candle here. That looks like a flag. That's a flag. So if that's a flag still there, then there's a good shot for the bulls to take control and move forward towards the 2800 level in the following couple of weeks. Not years, following couple of weeks. And at that point, there has to be big selling. So that's basically what it is. And we know what the uptrend line is. So this is looking good. We shall see. Now, that doesn't mean that intraday you're not going to get jostled around because the market's moving in 50 point, the Dow Jones going back and forth 50 points. So that's just, but bigger picture has to be, one must keep an eye on the larger picture so that if you have calls, let's say a month out, then unless something dramatically changes, you want to cost average slowly or just sit there. And that's what we're going to get into next. Next, what we're going to get into is the craziness of the market on a daily basis. All right? There's nothing we can do about it. Volatility, I detest volatility. Crazy, unstructured volatility. I really do. Because it just messes up everything. But that's what the machines want to do, and we got to live by it. This is a 15-minute chart, and and this is what's been going on. Now, I call it the tarantula pattern. It's kind of a joke. All right, there is no pattern called maybe I should copyright it because it looks like a tarantula. All right, looks like the spider. So this one, if you look at it, is I called it here, and if you remember going back on the chart, I called the pattern symmetry here, and I said this is the same pattern symmetry as May 11th, and I called it here. Well, guess what happened? The market went here, and it was very profitable. This was the weekend, and then this is what happened. But exactly from that level. This is the same level same pattern that I detected. Difficult for others to detect, but hey, that's my job. I saw positive divergences here, down here. That's why I wrote it. And it went there. Once it went there, it pulled back. Bang! It went straight up. Hit a major downtrend line at that 2732 level, and then created a if you kind of squint your eye instead of looking at every single candle, let's do it from here, you can see what it's doing. There's multiple fast moving patterns in play, and very difficult to trade, to be honest with you. And if you do trade these type of extreme volatility on a multi-day basis, this is from the 16th, right? This is from the 16th. So you're talking 2 days. It's 2 days, and this is the 18th, Friday. So you want to do it with small amounts of money, and not like have any real conviction of what's going on. And we saw that on the previous charts. The market has conviction, but there's no real conviction. And by the time there's real conviction, it's too late because it's going to go there. Boom, 300 points. And then it's time to reset, you know. So those days of like, oh, we can see that so clear, this and that. The only time I can see it very clearly is when on my quad system. That's the Algo HFT one with the dog background. I see the slow stochastics very deep oversold, and then they start to curl up. That's when I know I can sit there for at least the next 48 to 72 hours or sooner, depending on how fast they get overbought, and make some real decent money. And this is the chart, what we call, which you guys know, right there. Let's clean this out. Now on the quad front, any of you can do the free trial. It got nothing to do with me. I've been using them, pay a subscription fee. A bunch of my members use the quad system because it's extremely powerful, gives you early warning signals. You mash it up with what you're doing. You look at my stuff, and bang, you make some real big money on this thing. I'll be happy to send you the little link that they sent me. You call them up, you do the free trial. I think they give you 2 weeks, and I pay quite a bit more for a more extensive version, but they give you a similar version. I think it's like 120 a month or something like that. It's not a trading platform. Okay, I have my whole code screen and everything set up on Quad, very easy on the eye to see, but you can put trades through it. You're using it primarily for charting, for real, for real.
Like TC2000.
That's correct. Like TC2, this is actually run by Bar Charts, and the company is called Quad. Yes, TC2000 is, I don't know what they do at Quad, but this is, I call it Algo HFT because I've detected more signals of this thing than anyone out there. So Quad is highly recommended for people who have, who would like to, test it out. I have a whole Quad training video, how to set it up and stuff on my YouTube channel. And it says QUODD, Quad. It's a Jersey City company. They primarily supply data and charting and stuff to lots of investment banks on the street. That's how I know about it. So anyway, so on the Quad system, when the slow stows, this is, this is not Quad. What am I doing? This is Thinkorswim. My apologies. Bear with me 1 second. No, this is Thinkorswim. There you go. Okay, bar chart says here. So look at the Quad system. How do I get rid of this? Okay, down here you can see this is the slow stows. This has been a almost close to the most perfect indicator that I have traded on a swing basis. Now, in the old days, swings meant, at least for the market, meant a whole bunch of, days or weeks. Now it's like just days, if not, days, I would say. So when this gets deep oversold, you are in the 80% probability you are going to get a fat rally immediately. Now that rally can last. This one lasted a day, from the 15th to the 17th, 2 days, and then it started to sweep down. Now at this point, it's not deep oversold. Change the color. It's not deep oversold. This is how you read my Quad charts. It's not deep oversold like it gets down here, but it's trying to balance itself out here at a higher low and possibly turn. Now this chart is absolutely it's like driving a Ferrari. All right, seriously, like it's pristine. Why? Look at the bull flag consolidation channel, the same thing that I showed you guys on the investing.com, but this is far more mechanical and technical. There's a pivot line here. There's my yellow dotted lines. Every time you see my yellow dotted lines, that's a pivot. The exact definition of a pivot is basically a jumping ground. Either you jump below or higher. But the exact technical definition, go to Investopedia and read on it. Okay, there's a way to calculate the pivot. This is automatically generated. So I highlight that with the dotted yellow line. The pivot right now is at 27.20 77 right there. So in other words, if it goes above pivot, it's going to bounce up towards the upper. There's a gap here. That's why there's a box, 27.30, and then this is that infamous 27.45 level that we keep on talking about, right? Upper end of the resistance is 27.50. Lo and behold, that's exactly what we just talked about in the last couple of minutes. So this one is still, to me, and I was really concentrating on this all day Friday, like, come on, give me a directional bet. Even though I'm long biased here based on what I see here, this is this one. This is S stock, that's slow stochastics. This is fast stochastics. The fast stochastics they bounced off the lows and they're looking like they want to do this. And the fast stochastics can reset up and down just with the markets going up and down 50 points on the Dow. It's really as simple as that. Now, upper end of the gap is 27.30. That's 10 points from here. That's roughly 70 points on the Dow. Once it hits that, you can clearly see it hits a resistance level. Upper Bollinger, downtrend line that I drew. Remember, this is quads chart, but then I structured it for my benefit and all your benefit. So this way you guys can clearly see it. People who trade, I have traders who trade maybe 2 or 3 times a week. One's actually your neighbor, Mary. And a great friend of mine, know him from the service, and he's not too far away from you. So he's, what do you call, he just comes in 2 or 3 days, or maybe 2 days because he's got his own business. He's really busy. And he'll trade off this chart and make a ton of money. And he's posted a bunch of his feedback. He'll come in, he'll buy maybe 10 calls of this, and then he'll make like $2,000, $3,000 and just say, okay, done for the day. And he primarily uses quad. It's some people, they just know how to read this very, very well. Now these candles on quad appear rather quickly, and you can see these movements. In my opinion, they're picking up, the data feed's coming from the same places, but there's something in it which is proprietary, and it's very effective for traders. So that's it. So the slow stow is not fully oversold yet, but a bull will say, hey, that's a higher low, because both of them kind of touch the same levels here, but it's a higher low. But these are the points where I have the markers. This is how you read my chart. The markers are not there to make my charts look pretty. The markers are there where major inflection points. You see these markers and these crossovers, these lines crossing, you want to be in that trade. Period. When you have these definitive crossovers, and I'm always highlighting this big time, that's your range that we talked about, the 400-point range. Red is major support at gap fill, and that's the upper end of the range. Either we break below the range, anything is possible, by the way. There's another gap here, that's where the red line is. There. That's an old gap that got filled and then we broke out of it. The monster Texas bullhorn pattern, which is the same thing as a W or an inverse head and shoulder with the head down here, left shoulder, right shoulder. That's the Texas bullhorn pattern, and it is basically this neckline breakout right there. All right, so it's an inverse head and shoulder. It's also a big W, whichever way you look at it. I like it. This one shows more as an inverse head and shoulder, even though it is a W pattern. If you cut all this noise out, that's what happened. And it broke out. Now, notice one thing here. The chart is structured to perfection. I'm not kidding about that. These two red lines. What is this? What is this called? Went up big, and then this channel, which I structured as a channel. What's that channel called? You guys know it by now. Something goes up like this. Something goes up like this, and there's profit taking. That's a flag and a consolidation channel. Simple English, consolidating profits. Consolidation channel generally breaks out. And how do I know that there's a higher propensity, probability that it's going to break out? So I position some nice trades there. Is I'm looking at the slow stows. The slow stows reset the consolidation channel for 2 days. It reset down to deep oversold, and then they started to turn, and I said, that's it. They're going to break out. Because just by looking at this, I don't know if it's going to break out. It could break down. But by looking at the slow stochastics, and I shared this as much as possible with you guys, it's with the slow stochastics turning around like that, I know that's a high probability big money trade. And these are big money trades. Big money trades. And then now we are here. Now, this one is kind of looking like a W, whether it goes up here, we already discussed this, or if it falls below this, we got that 2700 to deal with. That's how you read my quad charts. Any quick questions?
No.
Okay. And the more you look at it, and you can always review this, this webinar and remember what how I explained it, then, then it's going to make more sense. All right. So this is your daily monkey on a hot tin roof. That's what I call it. Just look at this. I call them bear kill zones because that's where the shorts die. That's a bull kill zone where these are the intraday flash crashes. And just when you think it's all over, they stop the market. And 2700 is a major support level. Okay? This big fat lines here. So can we drop 2700? Absolutely. But that's 13 points from where we are. 13 times 7, you're looking at roughly 100 points on the Dow from here to here. Again, other day I shorted twice, made money. Third round, lost money. Why? Because this candle just boom, they run over you. And these were the cheap SPY calls. And I'm sorry, puts. So I thought, okay, maybe it's going to come down here. Nope. This big machine came in, started to drive it higher. Big machine came in at that's what it does. So this type of thing, there's nothing we can do. We just have to kind of, there are patterns I'm drawing and stuff, and it's very structured. But you can trade these 15-minute trades. Each of these candles are 15 minutes. So 1, 2, 3. That's 45 minutes, and you can make yourself a good 60-70% on the SPY calls. On this drop, you can make yourself, again, 60-70%. But the problem is, and one thing about Clueless Trading, we're transparent. We don't make up stories. We tell you the reality of what happens. The problem is, right when it looks like it's going to drop, they come in with the buy programs. And there's no way you can go that crazy with the stores on the 15 minutes because it can just turn. It was coming down nicely. So somebody put in a trade, let's say at 9:30 in the morning. They're like, oh, yeah, I'm going to short the market. Futures are opening down 7. Next thing you know, at 9:45, look at this. Bang. And we traded this. Bang, straight up. Where? To the upper end of the range. Right there, they started selling. Look at this. Nothing more to say. That's just intraday stuff. But if somebody has time, they can trade off these things. Let's move on. This is your VIX. I watched the VIX. I watched the VIX on quad, which is far more specific. But this is what we're seeing on the VIX. Does the VIX blow out and go higher? That's when we drop those 100, 200 points. Correct? So you understand how to read the VIX when I'm showing them. Right there. This is your downtrend line on the VIX. This is your major sell point, the 20. Before that, it's 17. Before that, it's right here at 14. That's your VIX daily chart. Now, the VIX I can structure it, but the VIX is a derivative, right? So what happens is the VIXen, as we call it, doesn't trade like a regular stock. So the movements are always exaggerated. Always exaggerated. But at least I'm showing it. There's your downtrend line. And there is a minor positive divergence going on here from the same levels. So can the VIX pop up on an extreme scenario? If the VIX pops up to 17 from here, we're going to go short very quickly because the VIX popping up from here to the upper end of this, this is a pattern completion, as you can see, just like the markets. This will happen very quickly. That means the markets will drop 300 points. That's Mary's 300, the 300 points that we talked about, the 378.
Mm-hmm.
Got it? And if it goes to 26, that means all hell's breaking loose, and we're going to drop about 600 points on the Dow. But it doesn't work like that. So right now it's kind of stuck in no man's land. That's how you read the VIX chart. Kathy, any questions? Thank you, Kathy. I'm actually feeling good about this presentation. I'm a pretty simple guy when it comes to things, despite all my tough image. But, well, if people cross me the wrong way, I'm very tough. No, just kidding. So the thing is that this will be extremely helpful to everyone who's listening. And once they want to move on to that next stage, like I always say, sign up for those ACA sessions. The other services charge hundreds of dollars for each of these type of hardcore sessions. And I think that what I set up like years ago is still there. It's like it comes to $50 a session, and you sign up for the 5-pack session, and that's how it works, $50 or $60, and it's really, really worth it. Okay, next one. Next chart is Apple. Now, why am I showing Apple? Because it's a leading stock. It's a leading stock. Now, is Apple going to hell in a handbasket by looking at this chart? No, it's the same things. I'll first want to take full credit for. No modesty here. I called Apple as a major buy right at this level. I actually called it a major buy right at this dotted line because this chart goes back quite a bit. And we have traded every one of these inflection points. So when the world and every single major guru analyst from Wall Street and the media, Apple's going to miss their iPhone sales and blah, 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 blah. I looked at this chart. This is when Apple was collapsing. And they're like, that's it. Their earnings are going to come out and, they're terrible, blah, blah, blah. I had different fundamental reasons from my days as on the analysis side on Wall Street and starting off from Boston. There were fundamental reasons why Apple would be a screaming buy, not just technical reasons. It fell below this. So there was a chance that it would hit these lower levels, which would be 154. And then this major pivot where the big fat candle started back in February, where again they were saying that's it, Apple's going to go to $100. You can Google it. That's what they were saying. From the forum, stock twits, other trading forums, and the analysts, and blah blah blah. And so this is a major support, 157.50. So I said, okay, let's see if we go to 157.50. I'm ready. Well, everybody's looking at that level, I guess. Or not everybody, because they don't even know what they're looking at half the time. But didn't go there. Turn. We went long. And that's a long. And then Buffett came in here. That's the earnings, the gap in the earnings. And my charts were constructed to perfection. Why? Because I'm a genius? Not at all. It's because I am strictly following the discipline of technical analysis. Tactical analysis my way. All right. So this was the uptrend channels that Apple follows. So it came in, broke above the gap, once in the gap, and we were long here. Okay. Stove started to turn. Once it filled the gap, it's back in that channel. You see these channels? Once you're in the channel and the green power moves start coming in, that was Mr. Buffett coming in, you're back in the channel. So it hit the mid channel, it created a bull flag, and now this is a bull flag, this one. And then it had a couple of days of consolidation. That is why this is your minor consolidation channel right there. Now, worst case scenario, what can Apple go? It can go to the major breakout level. What's the major breakout level? Its previous all-time high, 183.41 or thereabouts, 184. Can Apple fall to 184? Absolutely. That means the markets are going to be down about 100 to 200 points, right? It's all correlated. But we're prepared. Is it possible it just comes down to the lower end of this channel, maybe another dollar lower, and then make a big move higher? Absolutely. We get a China trade deal, or We don't get a perfect trade deal, but we get a negotiated thing. Apple will enter this bull flag so fast and head towards 198. At one point or another, Apple's going to hit the $1 trillion mark, in my opinion. But forget about $1 trillion mark. That's at the 204 level. Is it a coincidence that they mentioned it at 204? It hits a $1 trillion mark, and it happens to be the channel that I had drawn all the way back on March 13th? Think about it. I'm no genius. I'm just a, I try to be as good as possible and better on following technicals and the way I structure my charts. This uptrend line was born once I got the reference point to do it back on, read the date down here, 13th of March. That's a long time ago. And that showed me that Apple was going to go to 204 at one point or another, despite these nice vacillations within this range and then the panic fallout. And then the analysts come out and they say, okay, the 204 is going to be $1 trillion. Well, we already kind of know that by looking at this from the 13th of March. And they came in here and they said, after the earnings, they came in May, 2 months later. And they said, okay, it looks like it wants to go there. Are they stupid? No. It's just that we're quicker in identifying things. And that's where Apple is. It's not a bad looking chart. Stows are strong over 80. It's a consolidation channel. But the bears will say, oh, look at that. It's got no juice in it. What are you talking about? I'd like to be a big buyer of Apple at the 183 level. Again, the breakout level. Because breakouts generally do get retested. Will it happen? Don't know. Maybe it gets up, tries to re-enter the mid channel. Remember, this is the mid channel. This is the mid channel. That's around, look at the price on the right, 190.69. Let's call it 191. Maybe the stock goes up to 191, fails, comes down, does this, retests. Or if it does enter, remember, this is channel number 3, channel number 2, 1. It enters the second channel, it's going to be a big fat blast up to about 196 or 197. That's when the market hits 2,800. Get it? You understand? See how everything is correlated? If we entered this channel with the this type of bullish engulfing breadth thrust type of move, that's when the markets, the S&P, gets towards SPX 2,800. Like they say in Little Italy, capiche?
Capiche.
There you go. See how things are correlated? It's not like, voodoo signs. Some people say, technical analysis is real voodoo. Yeah, it's real voodoo because you just don't get it. Now, showing you a couple of charts on the swing side. Very important to trade these stocks. I don't care whether you know them or not, okay? I'm not going to put out a stock out there because I don't know it. This is TTD. Look up on the company. I'm going to give full blast compliments to a fantastic member and a friend. Okay, Brian C. Big shout out to you, who mentioned TTD to me all the way down here, back in April, back in March. I had no idea what TTD was. Trade desk. Nothing to do with stocks. Online advertising. Okay? Streaming on streaming networks. Google uses them. Big time. Look at this runaway breakout. This is a prime case of why you cannot have a closed mind. And this is for all members. In fact, this introductory free session is going to be the mandatory viewing for all members. Because it covers some serious points. You cannot have a closed mind. You cannot be, I'm just going to trade Google. I'm going to trade Netflix and Apple. And then that's it. No, you got to have an open mind. The market stock market is a market of stocks. If you have a closed mind and you don't want to take these trades, you are the worst loser, not me. So TTD broke out. I mentioned it during earnings first, before earnings. I had no clue earnings were going up like that. I just buy a little bit. I buy a little basket of a bunch of choice ER trades or earnings trades that I like. One doesn't work, two doesn't work, two just go through the roof. Fine, I'm up. So TTD is on a major breakout. This is a high momentum breakout. Stock was 43% shorted. I even mentioned that after I started to see this type of moves. I told people to buy here. I said this was a bull flag. I told people to buy here, and look where it is going. This stock is going to $100 eventually, very fast, because this is runaway breakouts. Because those shorts, which were 43% shorted, said, this company can't do much. Yeah, well, this company can't do much. I mean, who knows? Google must buy them for all I know. But looking at the technical charts, each of these lines, as the stock's moving, you know what the channels are. And these calls, at one point when I mentioned them, they were around $1.50 or $2. They're above. I'm looking at it. They're above. These were the 75 calls, if you remember. I had mentioned the May 1875s, and I said go out to May 25s, move up the strikes. Those original ones were they're a little bit more than $1. I think they were $2 or whatever. They're like almost $17. That's 800% plus in what, weeks? No, within 1 week. Now somebody said, as if you knew that. That's you get some idiotic statements like that. Of course I didn't know. That's the reason why you trade Clueless 8 Trading tactical charts. And if I didn't know everything, I wouldn't tell you guys. No, I'm just kidding. All right. I'd raise my price up to $2,000 a month or $20,000 a month, $2,000 a month, and say, listen, I know everything, such as and you get these garbage services and a lot of the big ones too. No names mentioned, who say these things. I don't. I simply say we are the best tactical trading service that's out there, bar none, period. Market forecasting, yeah, we're definitely up there. Stocks, up there. So that's it. You don't need to know everything. You just react to it. Let's look at the next one. NVIDIA. Now, this is a high beta momentum trading stocks. I mentioned NVIDIA other day, and this is a 15-minute chart. Good. So that's showing you the short term. NVIDIA was traded many, many times. So the other day we mentioned it was just on the 17th. We mentioned it on the 16th. We mentioned it on or what do you call it? This is the 16th again, on the 15th. Now, what day was the 15th? You can look up my alert. The 15th was a Tuesday. NVIDIA was moving down, breaking down. I said, look, hitting the gap. It's going to jump from the gap. Okay, and look what it did. It jumped 3, 4, 5 points. Then you get a Goldman Sachs upgrade saying NVIDIA and AMD and Micron are going to, they're the best chip companies in the world. Who cares? We're trading our charts. Before that type of recommendation coming in from a major investment bank, and on top of that, some of the 13F filings were made by hedge funds as to what stocks they own, and NVIDIA was mentioned in one of them. So here, NVIDIA sold off at the end of the day. Now, what you do with this type of stock, very important, you don't marry it, you rent it. If you want to marry NVIDIA, the stock's going to go to 260 and higher, in my opinion. They're a world-class company, next generation. But I'm talking about directional trading on a short-term basis, overnight, 2 days. You got to trade these charts, because if you don't look where they're selling off, look what happened. It hits the upper end of the gap and it sells off. So can't you trade NVIDIA for 3, 4 points? Good for 100 to 150% on your calls. I don't trade short NVIDIA because I think I've shorted NVIDIA once or twice, and it's too dangerous for me. Let the other smart shorties, short NVIDIA. But at this point, I'm looking at here again is a gap. It filled the gap. It can fall back to 243, 2 points. Great, buy it. Unless something dramatic happens to change the whole technical structure and the stock falls below 239, NVIDIA is a buy. And a buy for 3 or 4 points. It just gaps open. So it's something you bought at 2 here, you're selling at 4. Great start to the day. Repeatedly. So that's high beta momentum trading, and you have the whole structure put in place. If it breaks over 252, it's going to go to the upper end of the gap, which is around 255, and God help it, if it breaks here, it's going to go to 260 and complete the pattern. Is that the end of NVIDIA? No, it's just the way you trade it. So that's a trading chart. The next one I'm going to show is this is another massive swing trade. GWPH, GW Pharmaceuticals. Any of you know what they do? They are the first company almost getting FDA approval and have got preliminary approval for cannabinoid infused medicinal drugs. Real company. Some people used to call it the Regeneron of cannabis. And they're working on children's epilepsy. We've been trading the stock all the way from down here. And look, that's why the stock is structured. This was a perfect swing chart. 2 weeks, 2 months, I'm sorry, since April. The stock has gone from the original levels of 117, 120 to 160. Calls which were bought at $3 or $4 are currently, they're not like, the call premiums don't explode that big. Those are currently somewhere in the 20s. You could keep on shifting them out. Original trade was buying the 140s, 130s, 140s, kept on moving the strike up 150, 160. Look how good looking this chart is. And now it's hitting the upper end of the scale. I did say this is a classic case of an ascending triangle breakout. There. Now, again, if you have a closed mind, you're like, I don't know what GWPH sounds like, George Washington Bridge. Well, then you're a stupid trader. Because why do you think the Russell small cap is going to gangbusters? Because all these stocks are all in the Russell 2000. End of story. This is a ascending triangle breakout. I wouldn't be surprised if this stock, which is has a sole players, a pure play in this medicinal cannabinoid, what do you call medicinal cannabinoid treatment and children's epilepsy. I mean, my God, it's a multi-billion-dollar industry, and they're working on other stuff. That's the fundamental stuff. You do it on your own. It can break out and go to $200. I can draw another channel here right in front of you guys. Watch, and I can tell you where this stock is going to go. Now, these are swing trades where you buy, you add a little bit more. If it's hitting your levels, you take the profits and move out to a higher strike, and you just let it do its job. Look at this. I just showing you. This stock is going up here. I don't need to know anything about the company. Now, before it gets up there, is it possible that it pulls back a little bit? Sure it does. This is a monthly chart, so there's been a lot of volatility in the middle. But you keep an eye on the price where you want to go. This is investing stuff through options. So can you pull back like this? Sure. But with 2 months of this much massive billions of dollars going in, you think it's a joke? Nope. And their FDA clearance, I think, comes up soon. We've been taking a look at it. These things can change the makeup of your trading portfolio big time. Big time. Then you have more room to trade the other things, spread your risk, because small portfolios, I know it's difficult. You can't just spread the risk that much. You have to move money from one thing to another, but that's understandable. But these things can change the makeup within a week, if not days. All right. So basically, that's it. And I hope you've found this extremely helpful. I need 2 things from you guys. Very important this weekend. And it's not going to take too much of your time. I need some feedback because that's our way of doing organic marketing. Go to the website. On top, it says testimonials. Please write a couple of on your own words. We never censor anybody's feedback. And on your experience with these complimentary advanced coaching sessions and your experience with Clueless Trading in the past few weeks that you've been with us. Extremely important for others to see. And as new people come in, check our site out and stuff, extremely important for that testimonial to show up. So if you could kindly do that by, this weekend, it'll be really helpful. Second thing I need, tell everybody that you know to follow us on the Instagram channel, Clueless Trading. We need to get up to past that 1,000 number or so. And just anybody, just let them see some of the stuff that we're putting up there, stuff we are doing, stuff we have done. and we'd like to grow our online presence. That's why we're doing it. Doesn't cost you anything. Just tell all your friends, anybody who asks you about stocks or whatever, just tell them to, hey, follow Clueless Trading. And then, of course, please try to get as many referrals as possible. Tell them to come visit us. This is what we do here. On that note, God bless you all. Let's have a great week, great month. Keep an eye on the price. Volatile markets are a real pain in the butt. I know that because I feel it. But at the same time, sit tight, keep an eye on the long-term charts, long-term charts, long-term charts, then the craziness of the short-term charts. This is what volatility does, right? And keep an eye on the VIX and these type of big name stocks like Apple, and then the big, fantastic swing trades that we're delivering. And I'm just showing you a sample of them. The fast-moving trading stocks like NVIDIA, GWPH, and that's it. Have a great weekend. See you guys next week. And please, a quick testimonial feedback would be fantastic from both of you. This will be recorded, uploaded to the YouTube channel, so tell everyone to listen to it. And please follow us on Instagram and get a lot of referrals. We need good people like you to join Clueless Trading. God bless you all. Have a nice weekend.